All right. So it says the recording is in progress. That gives us the go sign here. All right, here comes the screen share. Please let me know if you can see the screen. It has my smiley face on it, and then we are ready to rock and roll. Yep. All right, here we go. All right, this is the disclaimer that we put out at the beginning of each one of these. It is on something you all should have memorized, but basically I am not going to be giving you any information that you should construe as advice for any trading decisions that you make. That's actually not completely true, because I hope that you pay attention to what we're talking about and it will help you in the trading decisions, but I'm not making any trading decisions or suggesting any specific trading decisions. How about that? And I know you all know what that implies. So let us begin. We have some events coming up. We always like to put the calendar up here in front of you so you can see the things that are coming up in front. Take advantage of these. A lot of effort goes into preparing these, and we will be extremely happy to see your attendance, and I think you'll be extremely happy to attend. As always, you can expect a high level of quality in the presentations wherever you go in Wealth Builders HQ. And with that, here we go. Turn signals and brake lights. Guys, I want to talk about technical indicators today. This is one of my favorite things to talk about, but it's a theme in part of the things that I train and teach students. There are some overarching principles, and a principle is something that does not change. It's a core principle. It's something that usually is ubiquitous. It can be applied in many situations and applications, and it has the same applicable intrinsic value. So I want to talk about it in that context. So turn signals and brake lights. We're talking about technical indicators, and here's the things that we're going to cover. There are no leading indicators except inside information. We'll go into some detail on that. We see the term leading indicators all the time. It's a garbage term. I want you to understand the context of it. It's a bad choice of words. Contrails and Sparklers. I'll explain what that is when we get there. How much weight can you put into a technical indicator? How many of them should you follow? Which ones are the best? Which ones should you follow? Okay, we're going to go into these are the questions that I hear a lot with regard to technical indicators, candlesticks, chart patterns, et cetera, et cetera. It's the same theme as you will see as we go along here. All right, turn signals and brake lights. I got to make a big point here. When I am behind somebody in traffic and I see brake lights come on, what does that tell me? It could tell me that the person is stopping, but it could also mean that the person's foot is just rested over on the brake and they're not even consciously touching it, but the brake lights are coming on. They have no intention of stopping. They just eased up because maybe they were going a little too fast. And so they touched the brake pedal, and the lights came on. You understand what I'm saying? It does not necessarily, now we assume that means the person is slowing down. Guys, brake lights come on if somebody stands on their brakes and they're going to be in a dead stop within just a few seconds, a couple of seconds. If you're not going too fast, they're going to be a dead stop and you are going to plow right into the back of them. Or the brake light could mean I'm still moving at the same speed. I just happened to touch the pedal and the light came on. You see, it does not necessarily mean any one particular thing every time. It could mean several things. And in the situation you're in, you've got to make a judgment. Same thing with turn signals. How many times have you seen somebody driving around with a turn signal on and they don't turn? How many times have you seen somebody make a turn without putting their turn signal on? You see, turn signals and brake lights are indicators. That's what they are. They're not magic. They're not prophets. You have to always look at it in context. What does it mean? What is it trying to tell you? In playing poker or things like that, they talk about the term a tell. That means somebody has a certain thing that they do unconsciously that's connected with a particular decision or a statement that they make. And if you figure that tell out, you got them nailed, except it doesn't always work. As you've seen in some movie scripts and scenes, someone will think they've got the tell figured out only to figure out that the person who had the tell knew that they knew the tell, so they gave them a false signal, yada, yada. All right. That's the point, guys. Technical indicators are tools. They are indicators. They are not prophetic. They're not right every time by any stretch. They give you something to work off of. And that's what it starts right there. You have to start doing some work. It's a starting point. It certainly is not an ending point. Now, can it be right to where you see the signal and it does exactly what it was predicting, exactly what it was indicating? Absolutely. But sometimes not. And sometimes it's really inefficient. And sometimes it's very efficient. In no case is that 100% efficient. So this is interesting now. 4 types and 2 types. If you looked up definitions for technical indicators, I saw 4 types, 3 types, 2 types, 12 types. There's all kinds of interpretations out there of the value of technical indicators, what they are for. But I will give you 2 definitions that I think are absolutely essential. One, there's 4 types. There are trend following indicators. There are oscillators. There are volatility indicators. And there is support and resistance indicators. Now, this is one way to categorize the different type of indicators, and you'll see the need for that here in just a few minutes. But there's always another way to look at it. You stand back and look at it differently. There's only 2 types. 2 types that you either overlay, you show the indicator. So in case, I should say it this way, there's 2 types of displaying. There's 2 types or 2 ways to display technical indicators. One, you overlay them, which means you lay them over top of the price. You put them on the same screen. The other kind, the oscillators, you do not put onto the screen. You put them in a separate window. So you overlay them or you put them in separate windows. Overlays are things like moving averages, Bollinger Bands. Those are things that are drawn right on the screen, and they connect directly with the imaging that the price is, and the imaging of the screen where the price is. Oscillators you put in different screens. They're on the same time frame. They line up on their dates and their times, but they're in different screens. Okay. Now, here's the fun. This is a pretty good list. It's not the absolute list of every technical indicator, but it's most of them. Now, if you recall, if you've been in any instructions with me on candlesticks, I tell you there is over 100 candlesticks patterns. You do not have to memorize them. I mean, each one has name, it has exemptions, it has rules. Yes, 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 yes. You check all this up, you memorize one, you go, whew, only 99 to go. And it's garbage. It's a fruitless effort. I did it. Okay, so I can tell you it's a garbage effort because I did it. I honestly did. Okay, I had to. When I wrote the book with Greg Morris, I did. And what I learned out of that is you don't need to. You don't need to. And you don't need to learn every technical indicator out there. What you need to do is to be able to understand how to use them. And then you can use whatever indicator you may want to use. But you have to understand how to use them first. And I say lions and tigers and bears, oh my, if you remember the movie, that it simply was referring to being confused. There's too much going on, too much input. Guys, price and volume are literally the only 2 components. Now, is there an exception? Yeah, there's a few indicators that will bring in something else, but essentially, almost all technical indicators are a different way of measuring price and volume, price movement and volume. Now, given that both of those are not future, they're all historical, we go back to the phrase, there are no leading indicators except inside information. Historical information doesn't lead. It can suggest, but by definition, it's just, I don't want anybody thinking that, oh, this is a leading indicator. This is going to lead price. Guys, nothing leads price, nothing, except inside information. It's not legal. It's not a good indicator. You can't look it up. But price and volume are the core of essentially everyone. And when you look at that list, it should feel like this. Oh my gosh, how am I gonna deal with this? Too much information. So let's get practical. Let's talk about how this can actually be practically put into place and utilized. No predictors except inside information, are leading. Okay, they're all following indicators because price and volume are historical. That's the point I want to make, and I hope that that sinks in. Forecasting. Can they forecast? Yes, we could look at them as forecasting. The reason that's a good choice is because here in Seattle, for example, they forecast the weather. That's good for maybe the next 20 minutes, if you're lucky. Okay, sometimes it'll be right. Sometimes it'll change. Guys, I watch my weather app here in Seattle, especially this summer, because it just kept getting too good and too good, and it kept going. I kept expecting it. Sure enough, every once in a while, they'd say today's going to be beautiful, and then you would see clouds come in. Oh, we're going to have a little bit of cloud, but no rain, and then you'd get a little bit of rain. It's a forecast. Okay, it's not perfect. It's doing the best they can, but it cannot predict a live action scenario that is subject to change. Everything is built on exact information coming from actual happening. Okay, so you've got historical, and then you can project, but the projection is a forecast. Okay, not a guarantee. I like contrails and sparklers as a visual because in the dark with a sparkler, you can start tracing a pattern like a figure eight. You start drawing a figure eight. At any point, you could stop. In the light, you still see the image of the figure eight before it disappears. That image, as you are moving that sparkler around, I hope you all know what I'm talking about, the 4th of July sparklers. You can get an image actually in the air if you're moving quickly. And it would say that, wow, that sparkler is making a circle. It has made a circle. Is it going to make a circle? Well, yeah, look at it. No, because at any point in time, you could vary the pattern. Okay. Now, I'm belaboring a point for a reason, because this is going to get down to how do you use this in trading decisions. This is a probability. It's likely. You can develop if-then scenarios off of this. Okay, so here's the value. If you have a pattern in a technical indicator and it starts to look like it's right, boy, this thing is a good one. My buddy told me it was a good one. That's always a bad choice of decision making, by the way. Somebody's saying, oh, this is a good pattern. I'm going to tell you exactly how to use technical indicators and how to know how good they are. Without learning all 100 of them, you're going to be able to know exactly how to determine if the technical indicator is any good and how much weight you should put on it. That's the value, isn't it? And that's what I'm going to show you. So if-then scenarios, you can look at a technical indicator and it says, so it is indicating here that we're going to have a move to the upside. Oh, okay. So you can do this. You could say, make a trading decision based on this scenario. If it moves up across this point, then I will enter and I will put in a stop right here. Now, guys, that's the way you do a good trading decision anyway, but now you're utilizing a technical indicator to assist you in making that determination. Because of the technical indicator, you could say if then, and you set up a conditional trade where you understand the risk and you get yourself locked into a risk scenario you're comfortable with based on the decision you're going to make on this indicator. Now, let's take a look at some practicality here. All right, and now we're going to put some rubber on the road, if you will. Here's an image of the Apple charting going back to October 2020. So this is a full year of Apple. I have, at the bottom of the page, I have an oscillator in red and green and an oscillator in blue and red or blue and purple or whatever that color is. The red and green one is MACD. The purple and magenta, or whatever that color is stochastics. These are two oscillators. Now, both of these are ones that I use. Both of these are ones that I have found to be helpful. But here's the deal. If you find an indicator that seems to work really well, you could say, wow, I'm going to use this indicator. The first thing you have to determine is, does it work on this particular stock that I'm looking at? Now, maybe it's worked in the past on another stock. Maybe it won't work on the stock that you're looking at right now. That is very, very possible. It's very normal for an indicator to work better on one stock and not very good on another stock, or an indicator, or index rather. Okay. Also, you'll note there is patterns that are drawn up here. Also, the chart is in candlesticks. Essentially, guys, everything I'm telling you about indicators applies to candlesticks, and it applies to chart patterns. They are helpful. They are not prophetic. They are not guaranteed by any stretch. I want to show you how to use them and how much weight you can put on an indicator. But keep in mind, everything I'm telling you applies to patterns, and it applies to candlesticks as well. All right. So let's take MACD. This is the red and green one. And we're looking back on this for Apple for a year. When you decide to use an indicator, the first thing you do is you want to read up on it and find out what it is supposed to do. What is this indicator supposed to do? If you read the rules on MACD, what you find is that this is an indicator that is you ready for a terminology? It's a contra indicator. In other words, MACD follows price movement. When it follows price movement, we want to ignore it. Essentially, we're going to ignore this. We're not going to be excited about MACD following the price because it does it all the time. What we are looking for is a divergence, a contra indicator. MACD is a divergence indicator, which simply means you pay attention to MACD when it diverts or gives a contra signal to what you're seeing in the pattern of the chart. Most of the time, MACD will follow the chart. 2 to 3 times a year is the typical occurrence where you will have a significant difference between MACD and what's going on in the chart. That's when this indicator shines. Now, you can say that in a generic fashion, and up to this point, everything I've said is completely true. Can you trust MACD on Apple? Answer, I have no clue. Yeah, but you said, yes, I did. It is an indicator that follows the price most of the time. 2 or 3 times a year, you'll get a significant divergence. That's where you want to look at this indicator. Okay, so if it diverges, then I want to go opposite. Well, potentially, but it depends. And you may get a good signal from MACD, or you may get a false signal. What you want to do in order to determine whether or not you could utilize MACD on Apple is to look back over about 6 months to a year and figure out, can I trust this indicator? Okay, is this indicator something that I can lean on? Well, let's find out. Okay, question, excuse me. There we go. If I move my mouse around, can you guys see my mouse as a indicator? Because in this slide mode right here, I can't draw on it. But if I move my mouse around, can you see the mouse? Hello. Yes, it's a white arrow. Thank you, Jim. All right, good. So look for the mouse. We're going to move all the way over here to the left. You see, I want you to, I have some light magenta or purple, light, almost pink vertical lines. I want you to look here because these are points where MACD gives crossover signals. Okay. One of the characteristics of MACD is that it has a center point. So if you look at the center of this indicator, these little red marks, they're right in the center. That's 0. When MACD goes below 0 or it goes above 0, then we are looking for signals. Okay. Then we're watching. If you'll notice, MACD, the green line crosses the red right here. Can you all see it? Green line crosses the red, and it's below the 0 line. That generally means a change and a move to the upside. What happened? Well, the stock moved up, sort of. You see, it was already moving up by the time we got that signal. That's true. Did it move up a little higher? Well, a little bit, and then it pulled back, but then it moved up again, and it pulled back, and it moved up again, and it moved. So we're in a strong bullish uptrend. What does MACD do? Watch. Higher highs, higher lows, higher highs, higher lows, higher highs, lower low, Interesting. So the pattern changes right here at the next purple. Y'all see this? We started with a bullish signal and the market moved up. And then we get a bearish signal. We're way above the middle line and we get a crossover. Green crosses over red and it says, look out, we're heading down. Well, guys, at this point, you should be able to see the blue line. We're following a trend. So just because MACD gives me a bearish signal right here, it gives me that signal really on a halfway pullback in an existing uptrend. Is that a time to go bearish? And the answer is no, not really. I'm still in an uptrend. So I've got the strength of a pattern and I'm using the indicator and they have to work together. You see, the strength is when you use all three of these together: patterns, candlesticks, and indicators. The indicator by itself is one voice and it's not always right. So in this case, I would ignore the MACD and I would say, unless we break down below our trend line, I would hold on here. Or maybe I would close the position and just wait for an opening, wait for a signal. Well, what happens? MACD crashes all the way back down to the zero line. That's the reset, the start over point. And what happens when we hit the bottom of the uptrend? We get a bounce, okay? And we surge to a new high. Great, that's great. Does MACD surge to a new high? And the answer is no. Now here is where MACD's second characteristic starts to get really important. So it gives us crossover signals above and below the zero line as turning points, bullish or bearish turning points. But trend strength changes. When we're going to have significant change in behavior is when MACD starts to go contra. Notice that the two peaks here are the same height, even though we surge to a new high. That is where you start to pay attention. Now the stock comes down, Apple comes back down to the trend line. As it gets down to the trend line, we get a crossover signal. The green crosses the red. So we've got a divergence. We've got a high that does not reflect a higher high. And we're getting a crossover, a second crossover. And we're at a trend line. It would be fine to wait until the red arrow and say, okay, with those signals, if it breaks the trend, I'm going with it. I would not trade right here when MACD gives the signal, the crossover signal. Not because it's not a good signal, it might be. It's giving me a bearish signal. The pattern will tell me exactly where to go bearish. You see? So now when I break the pattern and I've got MACD in a downward push, now I could make a bearish trading decision with more confidence, knowing that the pattern and an indicator that I like are giving me the same signal. Now, why would I trust MACD? At that point, I wouldn't unless I could look back a year. Well, that was last January. And so I would have to look farther back in order to see that. But if we're just learning this, if we're just studying Apple, we would say that was a good signal where MACD gave a divergence because it was throwing a divergence. It was not a higher high, and you get a crossover signal above the zero. Does it correlate with a break in the pattern? It did. Say, okay, this one back here correlated. Okay, so there's one, there's two. Now let's move to the next one. What happens? We get a break in the pattern. The stock comes down. We throw 1, 2, 3. We throw a triple bottom here. Okay, we throw a triple bottom. We see that the bottoms of the pattern are higher. We look down at MACD, we're well below the zero line, and the bottoms are moving up higher as well. So again, what is it doing? It's following the stock. Most of the time it follows the stock. Okay, so now we get a triple bottom. Is that a trading pattern? Yes, it is. We get a MACD signal right here as it crosses over. And in this crossover to the upside, we've had a triple bottom. We could say, well, on the strength of a triple bottom and a MACD crossover, I could take a bullish position. Does it work out? It does. It works out very nicely. MACD comes up. It tops once, twice. There's two of them. It pushes up for a third time. So we have a triple top right here, and then it rolls over. Well, what's MACD telling us? Guys, take a look here. MACD goes up and it follows it just like it does most of the time on the first one. There's the second one. And when the stock moves up, Apple moves up for a third high, MACD goes, yeah, I don't think so. And the green crosses the red going down. That right there is a bearish signal. Now, that could have been taken at where the this pink line is, or it could be moved over 5 days and taken 5 days later when it follows through on that failed triple top. But anywhere in there would have been an okay place to go bearish on the strength of a pattern and a MACD crossover and a MACD divergence. So this divergence is key here. The stock moves up for a triple top and MACD starts rolling over after the first one. And it's going, nope, I don't think so, don't think so, don't think so. See, I told you so. So we say, okay, well, so far MACD is 3 for 3 in its divergence signals. Okay. Now the stock moves down, moves down, move down. We've got two bottoms here. We come down, we hit a third, we hit, and then we trade into a wedge pattern. We trade into a wedge pattern. Now we know wedge patterns are significant or can be significant, and we wait for the stock to break out of the wedge. You can see it breaks out of the wedge here to the upside. But where did we get the signal that that may likely be the case? You see MACD, the bottom's moving to the upside. The stock, the bottoms are moving to the upside. No divergence, just a confirmation. So now we have the strength of a nice little wedge forming right here. We have MACD saying we're thumbs up on a bullish move. Well, you know, we can't give you any indicator. We're not giving any divergence. We're agreeing with it. So MACD would say, well, if the pattern says good, I'm good with it too. So you look at the pattern, you look at MACD, and you round the breakout, you could make the trade. And do we have a good trade? We do. This thing rallies, 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 rallies. We go up to a new high. MACD goes right with it, all the way up to a new high. Yay. Then we pull back, normal, up, down, oh, there's a wedge again. So now we've got a powerful wedge. And what's happening to MACD? It's collapsing. It's falling back to its 0 point, to its neutral point. It's giving you no signals here whatsoever. None. This is where going sideways at 0 is nothing. Then the stock moves up. Oops. Then the stock breaks out of the wedge, trades into another wedge. You can see it right there, another tight wedge. Then it breaks out again. So we have this upward trend where the top lines are lining up, the bottom lines. This is great. And then as they hit the top up here, MACD rolls over. You can see that MACD did not go nearly as high as it did on the last big run here. So MACD is going, yeah, this is not so strong. If it was a really strong move, MACD would have been pushing right up to the top of its range. It goes up from 0 to 100 in both directions. And so it went up to about 50 out of 100 right here. Instead of up here, it went to like 98. So this is not showing a whole lot of strength in MACD. It says we're showing internals that are breaking down. And it does break down. And if you extended this blue trend line up here, that would be your break point, and down it goes. Okay, not necessarily a good signal. Again, most of the time, it's just going to follow the stock. But it was here saying, yeah, it's kind of weak. It's kind of wimpy a little bit. What we have now is very interesting. As we've broken down, we're down to a support level. We hit the support level, the beginning of that wedge pattern. It's trading up. We're still throwing lower tops, lower bottoms. It's still bearish. It's still bearish for sure. MACD could push way down below 0, but it's starting to hook. That green line is starting to hook. If it were to break to the upside, cross over the red, that would be the crossover signal. And you would say, do we have anything else? And you go, nope, it's just following the stock. All right. So we look back and we had what? We had 3 occurrences over the course of a year where MACD showed us divergence that was accurate. 3 times out of 3 times. Most of the time, it just followed the stock. Most of the time, it just followed the stock. That's what it's supposed to do. But 2 or 3 times a year, you'll get a divergence signal. You pay attention to that. Why? Well, because with Apple, it was right 3 out of 3 times. Now, if you looked at another stock and you found 3 divergent signals and it was right 1 time out of 3, then you would know exactly how much weight to place on a divergent signal from MACD on that particular stock. In this stock, in Apple, it's accurate. Over the last year, 100% of the time. What are the odds that it will be accurate the next time it gives you the signal? I'm going to let you think on that for a little bit because it's a trick question. What are the odds that Apple's MACD cross or divergence signal will be right next time? Think about that. Now, am I going to go in and teach you stochastics? No, I'm not. I showed you the process with one indicator. You apply it to all of them. Find out what it's supposed to do. Find out the rules. Then look back over the course of a year and find the examples. Does it give signals? Yes. Are they accurate? Well, and then you come up with some rating. 3 out of 5 times, 5 out of 12 times, 9 out of 10 times. Right? Those are the ones you want to pay attention to. 3 out of 3, that works fine for MACD because you're only going to get 2 or 3 a year. Other indicators, you'll get a lot. Okay. Recent past is the best predictor. Guys, this is true with candlesticks. This is true with chart patterns. This is true with indicators. How good is good? Somebody says, oh, this is a good one. Well, what does that mean? I don't know. And neither do they, quite frankly. Candlesticks, patterns, and, candlesticks, patterns, and indicators all act the same way. Don't fall in love with them. Make them prove their value to you. I've showed you how to do it. Choose an indicator. Study it. Learn the rules. Look back over recent history. Go farther back if you have to. If 6 months isn't clear, go back a year. Usually a year should help you form a determination as to whether or not you can trust this thing. Look at the context. When it gives signals, where is it? This is where you look at the signal and the chart. Your chart patterns are key. You've got to look at the patterns. If it's in a wedge, if it's in an uptrend, in a downtrend, in a double bottom, a triple bottom, look at the context and then look at the signal. That's how you will get a better use of the indicators. Then you use if-then setups. If it does this, I'll do this, and I'll put in my stop here. My target is here. If I get within 80% of the target, I'll start thinning it down and start taking profit. Whatever your trading rules are, should be based on fundamental patterning. There's my support, there's my resistance. I've got a strong trend. Okay, a trend is still support and resistance. And you build your scenarios based on good risk management. The indicators are simply another voice. They're simply another voice, guys. How much weight should you put on that stock? It's going to tell you. I have a phrase that I came up with that I love. It's a great, great phrase that says, listen with your eyes. Now, I ask you to contemplate a question. If an indicator's been right 5 out of 5 times, 8 out of 10 times, 9 out of 9 times, what are the odds that it will be right the next time? And Tripp has the answer. He says 50-50. This is what I wanted to make the point to all of you. Guys, every single time it's a coin toss. You use these indicators to weight how much of a risk you're going to place on this. Okay? It still has to be an if-then scenario. If this happens, then I will act, and here's my stop, and here's my target. And this is the 4-to-1 ratio or 3-to-1 ratio that I'm going for, whatever your rules are. But you base those off of good information and good risk management and good strategy. Okay? Again, when you look at the chart, look back over the course of a year. You're looking to see if the indicator does what it's supposed to do. Does it give you signals? Let me just give you one example. Follow my cursor. I'm going to the middle of the chart, down at the bottom. I'm moving it around so you can see. The indicator underneath here is stochastics. Stochastics is different than MACD. Okay? It's a strength indicator, but it is a divergence indicator as well. When you're moving down, you'll see that the purple line trails the blue line. The blue line leads. When you're going up, the blue line leads and the purple trails. And when you get to the top and the bottom of your range, then you look for crossovers. However, it also adds to the divergence. I love divergence because it shows internals. It shows that the internals of an engine, for example, are breaking down. It still starts, you still drive, but it's getting a little bit kind of sluggish and you have no idea that it's about to seize because it's run out of oil. You can still drive it. You put it in gear and suddenly it doesn't work. You go, whoa, I didn't see the signals. Well, you mean that flashing red light on the dashboard didn't give you a clue? Oh, I didn't know what that was, right? Well, the ignorance can be expensive. Look in the middle again. You see, as MACD indicated, when the stock went 3 times higher on these triple tops, MACD was going the other direction on its tops. It says, nope, I see problems. Look what stochastics was doing. Nope, 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 nope. Both these indicators going, no, this is over. It's weak. It's falling apart. Yeah, but it's still going up. Yeah. And then, yeah, see, I told you. So stochastics can also be an indicator. Look over here. Okay. As the stock was surging higher and higher and higher, MACD or stochastics plateaued out. Okay. Well, that's not so much of a big deal there because that's the max. It was like bouncing along the ceiling. It's a very strong push to the upside. All it can do is bounce along the ceiling. What you want to look at is when it starts to go down when the stock is going up, or it starts to go up when the stock is coming down. Okay, that's where this indicator at its extremes, high and low, will give you the best signals. Now, I'm not giving you enough information to know how to trade stochastics. That wasn't the point. That's not what I'm trying to teach you here. I want you to know that you can use any indicator, and I want to show you how to learn to use that indicator. And maybe it's a good one, maybe it's not. I don't know. You look back historically, if you can make sense out of it and it helps you make good decisions, use it. I don't care what it is. I don't care what it is. Guys, if you want to just really dive into this, knock yourself out. And you will. You will literally knock yourself out trying to absorb all of that. It's nuts. Okay? It would be a nutty thing to try to do as far as I'm concerned. But keep it simple. Keep it simple. 3, maybe 4 indicators. You don't need 12. Okay? You don't need 12. I basically trade with 2, maybe 3. Sometimes I use RSI. And I use the chart patterns. And I use the candlesticks. And those together give me plenty of information, okay, to make good decisions on. All right? I suggest looking into MACD, stochastics, moving averages, maybe RSI, just as a starting point. Am I saying those are the only ones you should? Absolutely not. You use whatever you want. Guys, you should be learning Fibonacci's. Is that an indicator? Yes, it's an indicating system for sure. What's it based on? Price and stock movement. Oh, imagine that. Price movement, volume. Everything's built off of that. Now, use them as a suite. Like I said, chart patterns, candles and indicators, magical, wonderful triangle. Very strong in my opinion. I like that combination right there. The stronger the correlation, the better. If your chart and your candles and your indicators all agree, that's a stronger signal. Is it 100%? No. As Tripp pointed out, it's always 50-50. Guys, always 50-50. When you're utilizing this, I would suggest learning how to use them in a suite. This trifecta, the pattern, the indicators, and the candlesticks. Doesn't have to get any more complicated than that. That's plenty complicated if you allow yourself to make it complicated. But that's enough. That's really good information. Now, I'm sure that there's some questions. We've got a little bit of time. I wanted to be able to address questions. Jim says, outside of indicators, I have noticed the price in December area to February shows a nice head and shoulders, and the current timeline shows a possibility of building the right shoulder. Good observation, Jim. Very good. What we're seeing right here, okay, is 2 things. He said December. If we look back in December, right in here, and we look at what's happening today, Jim, I was hoping you were going to see the correlation. Maybe you already did on that. You have the pattern. You have the head and shoulder pattern building. A head and shoulder pattern is always on a correlated basis. In other words, the head and shoulder pattern is when you take out the neckline. The neckline being here's a shoulder, there's the head, there's the other shoulder. The neckline are these 2 dips right here on either side of the head. That's the neck. Okay, when you come down either side of your head, you're going to land on your neck, you know, where the neck and the shoulder hit. In this case, they're moving to the upside. So you have to extend that line. If it was sideways, you'd wait till it breaks down through the neckline on the right shoulder. In this case, the break on the right shoulder comes before the neckline because the neckline, it looks like it, it's not really, the neckline is sloped in this upward pattern. That's the break. Even though it's higher vertically than the either 2 points on the neckline, it's still the right place because you're breaking the pattern, and that is a head and shoulder. So Jim, look over here. Could you not see a head and shoulder pattern developing here as well? I do. Okay, I do. Now, when will we know it's a head and shoulder pattern? Well, number one, we have lower bottoms. So in this case, the neckline is sloped to the downside. If this rally fails and rolls over, I would take it right there. I would start the trade. I wouldn't wait till it goes all the way down to 138 to break the neckline. Okay, I would, if it moves up a little bit and rolls over, I'd start a trade and then add to it if it breaks it, builds the neckline. But do you see that, Jim, that we're having a similar pattern right now that we had back in February? Okay, good. Other questions? We got about, I don't know, 5 or 10 minutes. We'll take any other questions from indicators and this. Guys, in this case, there was not a lot of chatter today. You either captivated or you were bored, and I can't see the number of people to see if anybody's left. So that would indicate boredom. But I've given you some solid good gold information, in my humble opinion. I hope that you've digested that and you see the value of moving these things together as an indicator, a group, if you will, of indicators, a suite, this tripod, whatever you want to say, you know, candles, pattern, and indicators. Utilize them together. Okay, so I'm hearing captivated, great insights, all that good stuff. Okay, good. Good. I just want to make sure I wasn't boring you. All right. Jim says MACD setting makes a difference. How good are they? You have 8, 18, and 6. What you don't see is the 6. 8, 18, and 6. 12, 27, and 9 is the classic setting for MACD. Okay. 12, 27, and 9. Those are the classic settings. TradeStation has 14 and 25. Well, that's pretty close to 12 and 27. Why do I use 8 and 18? Guys, for the shorter term trading, which most of us do. In other words, time frame has to do with the numbers you put in here, because these are numbers of data points, 8 days of trading, 12 days of trading, 27 days of trading. The more the numbers, the longer your time horizons are. For the type of short-term trading that we do, I am very comfortable with 8, 18, and 6. They are simply percentages of the 12, 27, 9. In other words, the 12, 27, 9, as the indicator was put together, I think is the right correlation. It's good. It was a lot of work went into doing it, but it doesn't mean you can't scale it. So I scale it a little bit down from the 12, 27, 9 to 8, 18, 6. Okay. That's a good comment, Jim. And can you do that on other indicators? Sure, guys. As you're studying it, if the opportunity there is to put in inputs, play around with it. See if changing the inputs a little bit. Try to keep them proportionate, but see if the scaling it a little bit up or down, depending on what your time horizon is. See if that makes the signal work better, guys. If it works better, it works better. You don't have to have permission. If it allows you to put in different inputs, that means that's what it's for. It can be customized. That's the whole point. If they did not want you to customize it, then you couldn't customize it. But guys, on a moving average, can you put in a 50, a 100, a 200, a 10? Yes, but can you put in a 13? Of course you can. You can put any number you want. If it helps in the modeling, if it helps in the signaling, if it's more accurate, use it. There's nothing wrong with that. Jim says, what is the 6 for? I don't see the third setting. Well, there's 2 settings in MACD. 12, 27, or 14 and 25, or 8 and 18 creates one of the lines. If you look down here, it says moving average 6. MACD is 8, 18. You see that? The red line is created by the 6. The green line is created by the 8 and the 18. So that's why there's 3 numbers in putting a MACD together. 818 and then 6, 1227 and then 9. Okay. All right, what else you got? Stump the dummy. For those of you old enough to know what that means. All right. All right, anybody else? If not, we'll wrap this up, guys. It's been awesome. I've had a good time this morning. I hope you got some good information. Again, I am going to back to the beginning. Right here. There are no leading indicators except insider information. Everything else is following. They're all following indicators. Contrails and sparklers are patterns. You see the pattern and you go, wow, I can follow that. Yes, you can, but it only means what it's done up to that point. It does not mean that that is exactly what it's going to do next. Okay, 50-50. Keep that in mind. How much weight can you put on them? It depends. How accurate are they? Okay, you're not going to trust it implicitly, but you can learn to lean on certain indicators because they tend to be right a lot of the time. And every once in a while, they'll disappoint you. But if they're right most of the time, that helps you make better decisions, doesn't it? How many? Keep it simple. Which ones are the best? I don't know. I like the ones I like. You like the ones that you like. Just use them correctly. Use them intelligently. Use them in a suite, and you'll find yourself much better served. All right. With that, guys, God bless. Have yourself a wonderful, wonderful weekend. It's always my pleasure to be here and take time with you. Let's see. I'm looking back up. Oh, Ichimoto Cloud. I looked at it once. Have you ever looked at it? Yeah, I've looked at a lot of them. Most of them. Well, not most of them. When I learned this lesson, I quit being enamored. I keep it simple. I like 2 or 3 that help me do my candles and my chart pattern because I'm good at both the candles and the charts. I trust, I like them. I just use as indicators as one more thing, and I don't want 12 more people yelling in my ear. Okay, that's all. You're welcome, everybody. You're welcome. You're welcome. Thanks. Have a great weekend. Let's see. Oh, thanks, Barry. Appreciate it. All right, guys, take care. Bye-bye now.